and I put everything into my portfolio, every tradable asset. Now, once again, not non-tradable assets. You're driving down the road, you see $1 million house, that they have $1 million price tag on. That doesn't make it a fair price. These are only market-traded assets. They also have to be appropriate for your tax position. You don't want to be buying assets. If you're in a low tax bracket, you don't want to be buying long-term municipals because you're wasting the tax advantages. If you're in a real high tax bracket, maybe you don't want to buy fully taxable investments. Maybe you want to buy municipals. So we want to take into account taxes when we do this as well. And I'm not talking just about U.S. stocks. First of all, I'm talking about stocks all around the world. And I'm not just talking about stocks, but I'm talking about real estate, private equity, maybe even some hedge funds exposures, some commodity pricing, some commodity exposure. I'm talking about every investment opportunity out there. And the way I look at it is you're trying to gobble up diversification. Anywhere you can invest in something. If somebody came down tomorrow with an investment on Mars, I'd be buying it. Because I just want to diversify. Because diversification is a free lunch. The more places I can stick pockets of money that don't move in the same direction all the time, the more I'm smoothing out that risk. And if I'm doing it with competitively traded assets, I'm doing it without sacrificing return. So the argument is diversify as much as you can. Now, one of the most wonderful things that this theory says is it tells you exactly how much to put into every one of those assets that you pick. It says to put in every asset in proportion to its size. So if you want to invest in another country, let's say I'm going to invest in India, how much money should you put in India relative to how much money should you put into the UK? And the answer, according to this model, and I really urge you to do this, don't try to speculate on whether you think UK is a better stock market with better prospects right now than India. I don't do that. If we think that we can beat the stock market, we fall into a trap of speculation. If we think we know which company is going to go up, or which state, which country is going to go up, or which asset class or type of security is going to go up, we fall into that trap I'm going to talk about in a little while. So what this says is invest in proportion to their size. So if the UK stock market is 20 times the size of the India stock market, this theory says put $20 in the UK for every dollar that you put in India. You say, that doesn't make sense. No, it does make sense. Because if we put all the investors together in the world, that's how they're investing their money. Because we know the UK stock market is 20 times the size of the India market. If it made sense for everybody to say, well, I'm going to make it more even than that, we can't do that because it's only 1/20th the size of the UK stock market. So that's a prescription which is so precise. Invest in everything in proportion to its size. Now, one more time on this issue, though, that's what the theory says. And of course, I'm not claiming this theory should just be blindly adopted. One thing that's important is a home country bias. I talked about this when I talked about the US dollar. If I were giving this seminar in Japan and I was saying everybody should put all their money in the US dollar, they'd look at me like I was crazy. Why would we put our money in the US dollar? But to say it in the US seminar, it makes some sense. Most people would put most of their money or all their money in the US dollar. Well, the same thing goes with the stock market. Does it make sense for an American to put all their money in the US stock market? Well, I guess it could make sense. I don't think it's the smartest thing in the world to do. I think you should diversify internationally. But what I've given seminars in Portugal. What if you gave, and in Portugal, would I say to everybody, invest all of your money in Portugal? That would be really a bad piece of advice because the Portuguese stock market is very, very risky. It's not very well developed. So what should a person in Portugal do? They should probably hold a smaller amount of their money in Portugal. Now this model would say that, what happened here? This model would say that a person who lives in Portugal should invest the same amount of money in Portugal per dollar that you and I invest in Portugal, which is probably less than 1% of our money. Do you think the people in Portugal invest less than 1% of their money in their own stock market? No, they invest a lot more. This is the home country bias. Portuguese tend to put more money in the Portuguese stock market than we do. Americans put more in the U.S. stock market, and the question is why? And the behavioral answer, the human nature answer to that, is maybe we're familiar with our own market. Maybe we're more optimistic about our own market. Or maybe, and this is the one that I like the most, the people around us are going up and down with the U.S. stock market. And we want our wealth to go up and down with our neighbors. That is actually a desirable trait. It's been miserable losing 50% of our money in the U.S. stock market. But we knew everybody else around the water cooler was doing the same thing. And there was some solace in that. Some real solace. I'm not trying to be condescending about that. It's important that we invest like our neighbors do to some extent. So I think some home country bias is important here. The U.S. stock market varies. It tends to be roughly 30 to 40% of the total world's wealth. In other words, the U.S. stock market relative to all the stock markets combined, the U.S. is maybe 35% of the world. That would say that you should hold 35% of your money in the U.S. stock market and 65% of the money that you're going to put into stocks. You would put 35% into the U.S. and 65% international. Well, not many people do that. That's a lot more international exposure than most experts recommend. And I have to agree that that's a lot of exposure. And even though the theory says to invest even only in your country into size to its proportion, I think there are some solid reasons to invest more than that in your own country. So if you were to start to say, what about a 50-50 allocation? Fine. What about 75% U.S. stocks? Well, I think you're starting to lose a lot of diversification if you go that much. But it's got to be your call. I'm not here to answer that for you. The theory actually says you should only invest 35% in U.S. assets, and you should invest 65% elsewhere. You should invest roughly 35% in U.S. dollar-denominated assets and 65% in assets denominated in other currencies. I don't go along with the theory completely in that. So to motivate this, and I see some skepticism. I get to see your faces when I'm talking here. You only get to see my face. And when I'm talking about this idea that, that Kodak is just as good of an investment as Apple Computer, that you can't predict when one stock is going to go up and another is going to go down, that they're all fairly priced, that they're all equal gambles, that you can't predict when the market's going to go up or down or when the U.S. is going to do better than the UK. I see the skepticism. So let me try to do this little thought experiment with you. I want you to imagine that everybody in the world is in this room right now. And let's just imagine that all the people on this side of the room follow the advice that I've been talking about. And the word for you would be your indexers. You are just trying to buy every diversifiable asset you can find in the biggest index that you can find, and you are just buy and hold indexers, and that's what you do. Everybody with me on that? People on this side of the room represent all the people in the world who don't do that. Now, why don't they do that? Home country bias could be a reason. These people invest all their money in the U.S. Somebody else is just really is negative about stocks right now, so they time in and out of the stock market based upon whether they think it's going to go up or down. Another person believes in value stocks. Another person believes in growth stocks. Another person has a particular mutual fund that they love, and on the list goes. There's market timers, stock pickers, mutual fund pickers, all sorts of people over here. So at the end of the next year, we know what everybody over here is going to earn. They're going to earn whatever the index earns. If the stock markets are good to us, maybe it'll be plus 20%. If the stock markets are bad to us, maybe it'll be negative 10%. Whatever it is, everybody over here gets that same return. What happens over here depends upon whether they're the good pickers or the bad pickers. Some of you might get 50, 60, 80, 100%, get rich. Some of you might lose everything. Trading in derivatives or whatever. But what happens if we put together everybody on this side of the room? We put all their portfolios together. If we put all of their portfolios together, what does that portfolio look like? It looks like this side of the room. Why? Why do we know that's true? Well, if we put together everybody's portfolio, what would we get? The market portfolio. So if everybody together owns the market portfolio, and if these people together own the market portfolio, then these people together own the market portfolio. So if we put all of you together, if they make 10%, you're going to make 10%. The difference is, if they make 10%, every one of them makes 10%. But when this side of the room makes 10%, some of you are going to make 20 or 30%. Some of you are going to lose 10 or 20%. Now, which side of the room do you want to be on? Why would you want to be on this side of the room? And I'll tell you why you want to be on this side of the room. Because you're the smartest man or woman that's ever walked the face of the earth. Right? Or you've lost money trying to be the smartest man or woman to walk the face of the earth, and you're trying to catch up. And it's a trap that people fall into, and they fool themselves. We are unbelievably good at fooling ourselves into believing that we've done okay.